Hey guys, it's Alfred from ABMG, and today I'm bringing you a presentation on fixed index annuities. Reason being because not a lot of people know what FIAs are, and those who do usually have some kind of negative stigma around it. Most likely because it's an insurance product, and people they don't really like insurance products as much as they like securities products. But in reality, FIAs are really great for building your portfolio and ensuring that you have a safe stream of income for retirement. So just gonna hop right into this, and I think the first thing we need to talk about is risk, because it's very important to understand what it is as a concept. A lot of people don't really understand what it is, but risk really plays a role in investing. They're actually tied together hand in hand. So what is risk? Risk is basically exposure to danger, harm, loss. When it comes to investing, it's the danger of losing money. And once again, when it comes to investing, there's always some kind of risk involved, especially if you're investing in securities. A very popular kind of illustration that people use for investing was one made by Warren Buffett, this investment risk pyramid. And if you look on this illustration, you'll see at the very bottom we have the foundation, the low risk tier where you should be establishing a majority of your retirement portfolio, and these are going to be your low risk, almost risk free investments. And if you try to invert this pyramid, it's obvious that it won't stand on its own, and that kind of signifies that if you have really risky investments, that your portfolio is pretty much doomed to fail, and you don't really want to put your hard-earned money into stuff, really risky stuff. You want to make sure that you're putting it into something that is going to guarantee you a stream of income for retirement. So let's move on to another way to visualize investing. Another way that I like to look at it is by visualizing a house. And the first thing that you need when you build a house before you put up the walls and the roof is the foundation, obviously. And in regards to investing, the foundation is supposed to be the safe, relatively risk-free assets, and really it needs to be a really strong foundation. Otherwise, the walls and the roof, which represent the riskier investments, they cannot stand on their own without this foundation. So it's very important that before you actually focus on investing in securities that are actually subject to market volatility, that you have something that you can rely on and not have to worry about. So these are just a couple of traditional investment vehicles. It's not all of them, obviously. There's a lot more, but these are the most common ones that people think about and talk about. And I just wanted to go over briefly what they are, just to gain an understanding of how risky they are and why they really shouldn't be used for your foundation. So stocks, everyone knows about stocks. Everyone is always talking about the stock market. All that it is when you're buying a stock is partial ownership of a company. And typically, although people talk about stocks a lot, the reality is they're very risky, and you never know which ones are going to work, which ones aren't. Even if they are really popular companies, very well-known companies, anything can happen. Everyone talks about Tesla being, this crazy stock in, the future. But, let's say that, like, hypothetically, Elon Musk dies tomorrow, right? If that were to happen, God forbid, but if it did happen, that stock would probably be substantially depreciated in value, and you don't want to be subject to that kind of risk when you're trying to establish a secure retirement portfolio. And options are similar to stocks because they also kind of speculate on the companies, but you're not actually buying the asset. You're just buying a contract that gives you the right to buy or sell a stock at a particular point in time and price. But both of these should be regarded as very risky, and you really shouldn't be messing around with them if you're trying to put your hard-earned money into something for retirement. Bonds are kind of seen as a safer investment because if you, let's say, you buy a corporate bond, they're usually much safer, but they offer very little return. And by the way, bonds, you're just basically loaning your money to corporations or governments. they're definitely seen as safer, but they're still at risk for at when interest rates rise, bonds depreciate in value. So uh, definitely not something that you want to mess with unless you're buying like relatively safe bonds. But at the same time, if you're buying safer bonds, they're not going to yield much much return rather. Mutual funds, ETFs, once again, it's they're speculative assets, but not as speculative as stocks because they're diversified, and they're basically these pools of funds that are collected together to invest in these portfolios of stocks that might be correlated to the broader market or to specific sectors. It's definitely seen as safer because if one or more stocks underperform in the portfolio, this underperformance is compensated for by with the performance of the other stocks in the portfolio. But once again, market conditions are relevant here, and it's still relatively risky, especially when you have the sequence of returns risk. When let's say you want to retire in the immediate future, but market conditions are depreciating your investment, and when you make withdrawals from your depreciated investment, it overall just cuts down how much money you're going to have in retirement. So once again, not a really good foundation. And I just wanted to give you an example of this. This is the S&P 500. Well, it's SPY, which is an ETF that's correlated with S&P 500. And just a prime example here, we have the 2008 recession here on the chart. And let's say, hypothetically, you wanted to retire in 2007, 2008, and I'm sure millions of people did. But if you were invested in the market at the time, you did get your investment cut in half, literally, in just a year and a half time because of this bear market. And it's really stressful to be in that situation, and it's not something you want to be a part of if you want a safe investment. This is not the volatility is just too much for a lot of people, and when these kind of things happen, people tend to make irrational decisions with their retirement accounts. They panic sell, they try to buy more or whatever. They stop thinking and they start panicking, and they end up screwing up their portfolios. So it's definitely a no-go on the mutual funds, at least when it comes to, this is all in regards to the foundation part of your portfolio. The foundation should be risk-free. Okay, so here's the thing. We want something that provides safety in regards to risk. We want something that provides high returns, right? If you put your money in a bank, you're going to get safety, of course, but if you buy like a certificate of deposit or you just open a savings account, the interest rate on those are going to be extremely minimal, and it's not even guaranteed that you're going to beat inflation with those interest rates. So you're not going to make much money with banks. And if you put your money in the market, certainly you have exposure to higher returns, but the risk is insane because you can basically lose all of your principal. So the question is, what kind of instrument can we invest in that gives us the safety of a bank but also exposure to market returns? And the answer to that question is an FIA, Fixed Index Annuity. Now let's get more into this. Fixed Index Annuity, it's basically a contract between the owner of the annuity and the insurance company. There's two phases for the FIAs. There's the first phase, which is the accumulation phase, where you pay the premium, and the interest rate is determined by the performance of a pre-selected index, such as the NASDAQ or the S&P 500. And using several different calculation methods, this index performance is used to calculate your interest rate. And basically, throughout your accumulation period for many years, whatever gains that you experience from this interest rate are locked in on an annual basis. And here's the thing. If the market is weak for 1 year, for a particular year, your interest rate for the annuity for that year will be 0, which means that you won't make any money with interest that year, but you won't lose any money. You won't lose any of your principal, and you won't lose any of the gains that you've locked in previously. Okay, this is very important. And the second phase of this FIA is annuitization or maturation. There's several different ways to describe it, but the second phase is when the insurance company starts making distributions to you, to the annuitant, based off your life expectancy. And furthermore, the main problem that FIAs are trying to address, more than just putting your money into something that's risk-free, is the fact that, yeah, you read that correctly, we are living too long now. We have started to expand our life expectancy due to better technology, innovation stuff. And the reality is we are living so long now that people are actually running out of their retirement money. They're exhausting their Social Security benefits, and this and that. There's so many different factors that you don't really consider before you retire. But during retirement, so many things can come up that can deplete your resources, and that leads to people running out of money during retirement. And as surprising as this may sound, a lot of people are actually more afraid of running out of money during retirement than they are of death itself, which is crazy, but it's true. So the FIA is kind of the opposite end of insurance, right? Life insurance. Life insurance, the goal of life insurance is to ensure that when you die, your family's protected financially, right? But FIAs are the opposite side of that, where if you live too long, they can serve as an income replacement in case you deplete your other resources. And this is really important because if you look at this chart here, we have a high rate of insecurity for elder households, especially in the states such as California, Vermont, New York, Massachusetts, Mississippi. As you can see, a lot of people are actually very worried that during retirement they're going to run out of money and they're going to fall into poverty, and that's not the ideal situation, obviously, for retirement. You want to be able to upgrade your lifestyle, not downgrade, or even worse, have to go back to work. So why fixed index annuities? As I previously said, that they provide income protection during your life. And the insurance company, specifically for fixed annuities, does not actually invest in the market, which means that it's not a securities product, it's an insurance product. Furthermore, since that they don't invest in the market, the annuitant is not exposed to the downside volatility. Okay, so here is a popular game that we at ABMG like to refer to a lot because it's actually a really good way to illustrate the value of an FIA. It's called Chutes and Ladders. I personally I've played this game, all throughout my childhood, and I've never really used it to illustrate, a financial tool, but here we are. So as you can see on the left, we have a version of the game where you're not invested in FIAs, but rather these other securities. And, the goal of the game is to get to the top of the board. And if you land on a ladder, you go up, and that kind of represents the stock market gains and stuff, right? But the thing is, the market conditions are always changing, the landscape's always changing, and whatever you're doing now that's working may not work in the future in regards to securities, right? So these chutes, these slides that you see, they represent, changes in the market that have an adverse effect on your portfolio, such as, crypto, stocks, bonds, options, all that stuff. So if you happen to land on a slide where, let's say you land on the crypto slide and you buy a bunch of crypto, but the timing was just off, and the crypto market just happens to be crashing when you buy, and boom, look how far down that slide goes. I mean, you've just cut your portfolio in half right there. That's your portfolio. That's the money that you've been saving up your entire life, right? You're so close to retirement, and this happens, right? This is not what you're supposed to be doing. This is not the smart decision to make when real life-changing money is on the line, okay? This is irresponsible. If you move over to the right side of the screen, you'll see a different version of the board where every time you approach a chute, it's blocked. Where instead of sliding down the chute, you just skip a turn. You don't move up or down, you just kind of stay in the same place. Well, what's happening here? Well, it's an FIA where you experience the gains of the ladders, right? But when you approach a chute, nothing happens because FIAs are not a security, they're an insurance product, and you're protected. Your principal and your gains are protected from these drawdowns. So it's very important, and I think this game here kind of helps visualize that. This is a chart that kind of shows the 5-year period performance of FIAs compared to traditional indexes. And you can see that in some market conditions, FIAs can actually outperform the market because the downside volatility is factored out. And for those who want a safer investment, this is obviously the way to go, because you don't want your investment to go below that zero mark. You want it to stay positive all the time. Right, so I want to take a moment to talk about passive investing, right? So a lot of people misuse this term, passive investing. What does it mean for an investment to be truly passive? Well, a passive investment is when you invest in something and you have to do absolutely nothing at all, and the investment grows nonetheless as if it has like a mind of its own or something. You literally do nothing, right? A common misconception is that, for example, real estate investing is passive. The only way you can make real estate investing passive is if you buy real estate investment trusts. But if you're actually going out and buying a real estate and you're looking for tenants, you're doing renovations, you're doing maintenance, that's not passive, okay? You're actually working. That's a full-time job, basically. A true passive investment is when you're doing absolutely nothing at all. And that's what FIAs are. You pay the premium, you set the terms of your contract, you do all that logistical stuff in the beginning, and then you do absolutely nothing at all. You just sit back and enjoy your life, care for your loved ones, go traveling, work, do whatever it is you do, and you just allow this thing to kind of work itself out over time, and when it's time to retire, you start getting those distributions, and it's all good. There's nothing to worry about. And it may seem too good to be true, but this is truly what FIAs do. This is the kind of stuff that you should be investing in for that foundation of your pyramid, or the foundation of your house, metaphorically speaking, of course. Thank you for tuning in. This is the end of our little presentation here. If you have any further questions on what FIAs are and what they accomplish, please feel free to visit our website at abmginc.com or call us at 818-719-6541. Thank you and goodbye.